We've just had one of the worst 30 days in the S&P in quite some time, and during this period, Occidental Petroleum is down around 8%, whilst we can see slightly different performances from other companies in the same sector, and year to date, many companies, including the Mag 7, are on a pretty poor run, and this also extends to Occidental Petroleum, which is down 3% year to date. Again, many others, if not nearly every single other one in the industry, has performed fairly well and at least positive, whilst the S&P is down around 3% year to date. It's also down around 25% over the last 12 months, and over the last 10 years, not only massive underperformance against the S&P, but actually negative 34%, meaning if you'd invested $10,000 10 years ago, you'd be sitting at around $6,500 now, less than your initial investment. It's also now trading near its 52-week low, with both seeking alpha as well as quant giving this a buy rating, although Wall Street are saying this is currently a hold, with the yield sitting bang on the 2% point. Now, for those that are slightly newer to the company, they are an energy one engaged in oil and gas exploration, production, as well as chemical manufacturing. They operate in the US, the Middle East, and Latin America, producing crude oil, natural gas, as well as petrochemicals, and the company also invests in carbon capture, storage technology to reduce emissions, and their chemical segment manufactures basic chemicals used in various industries, including construction and agriculture. It's also one that Warren Buffett has continued to buy. In fact, just last year, there was a period of 9 straight days where he kept on buying, and his stake was getting higher and higher within the company. Again, in December last year, he continued to add to his overall portfolio, and just last month, as we can see, where the company was down around 30% from its record highs, he continued to add, just showing us how strong of a conviction he has in the company. We can also see the amount of shares he bought in the most recent quarter, around 9 million shares. He didn't buy any in Q3, but he actually bought in both Q2 and Q1. In fact, quarter 2 adding around 7.3 million shares, and in Q1 we do also notice around 4.3. So this is one that Warren Buffett still likes and has been buying, and as we can note, a drop of 25% just over the last year. It's also one that institutions quite like, with around 89% ownership. They've sold around 1.73 billion over the last 12 months, but they've been buying a lot more at 3.1. Something we also note, in fact, in the most recent quarter, they bought 3 times as much as they did sell, so very similar to Warren Buffett, who's actually at a current loss, so institutions are very bullish overall, or at least in 2024. Now, if we look at the forward valuation of the company at 13.4, it isn't dissimilar from their 5-year at 12.8, so we would say this is a possible reasonable signal, but if we looked at dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year, we'd be looking at a possible undervaluation signal, offering 2% now. Over the last 5 years, this is sat much lower at 0.88. We then move on to another model, although bear in mind we're not looking at any of these in isolation, we'll run it through our own process shortly, but we have the blue tunnel, which dictates the expected fair price. Interesting to note, it hasn't been increasing over time, something we want to see, bit of a roller coaster, but right now we notice it in the mid to upper end of this expected intrinsic value, thereby telling us it does look like a possible reasonable signal, but again, we're going to run it through our own process as well. In terms of the valuation grading, they do get a D. They are trading at a premium, given the sector sits at 11.6. You're paying around 19%, and if you do look at other valuation metrics, you may come to a slightly different conclusion, so it does really come down to how best the valuation of Occidental Petroleum should be analysed. We also like to take a look at their revenue growth, given the fact they are in a cyclical industry, and from a graphical basis, whilst not consistent, we can see growth. In fact, from 10 years ago, 2015, they reported 12.5 billion. We do note in the most recent annual accounts, December 24, they have pretty much doubled that top line, sitting now at 27 billion. We also want to dive a little bit deeper to understand what is the story the bottom line net incomes tell us. Is it a very similar one? And actually, it is not. As we can see, not only very inconsistent, but we do notice a few years where in fact they reported a loss. In 2015, they reported a 7.8 billion net loss, and in the most recent annual accounts, 3.1 billion. But the point to note here, very cyclical, and that also includes a very inconsistent bottom line net income. The other thing we want to highlight is the health of the company, a quick cash versus total debt, and we've noticed their cash position has been decreasing over the last 10 years, going from 3.2 billion in 2015 to now sitting at 2.1 billion. But as always, one number here, pure isolation, isn't going to give anything away, so we compare it to their total debt, both numerically as well as directionally, and what we in fact see is not only has their cash been decreasing, but their total debt has actually increased quite significantly over the last 10 years, going from 8.3 billion in 2015 to now sitting at 27 billion. Definitely something we would say to consider further, and that is why we like to apply a margin of safety when we get to our own valuation model shortly. Cyclicality showing through their earnings, with only 2 of the next 4 quarters expected to be growth. However, having said that, over the last 4 quarters they have outperformed every single one, 4 out of 4, and based on the EPS of $3.50, we can see a forward valuation of 13.7. Now growth comes in at a B-, although pretty poor year on year, -5%. That is still well below the sector at the low single digit and well below their own 5-year of 12%. Moving forwards, pretty much expected to be flat, with both the sector at the low single digit as well as their own 5-year average, and we also notice EPS expected to grow at 13% over the next 3 to 5 years, quite some way above the sector at 8.5, and also a lot better than what they have seen historically at -1%. And it's probably better visualized here when we look at their sales growth on a percentage basis. In fact, over the last 10 years, their top line revenue has been decreasing for 5 of them, with the last 2 being negative, 2023 -23%, and in 2024 -5%. Profitability looking good though at an A, gross margin 63%, above the sector at 46%, a little bit higher than their 5-year at 61%. Bottom line 12%, again above the sector at 9% and above their own 5-year where they've been losing money, -4%. And we can also see very large cash generated from operations at 11.4 billion, well above the sector at 584 million, but also well above their own 5-year at 10.5. Again, you will notice across the majority of their metrics, and including here their margins, a lot of inconsistency given the cyclicality. In fact, we don't notice a positive operating margin every single year, and we also want to see above 12% for oil producers. Again, not something we note. Free cash flow a little bit better, whilst it is above 5% for the majority of the years. There is no real consistency, but at least good to see 16% on a trailing 12-month basis. We also like to flag the dividend growth at 9.1% in February, so just last month, but over the last 5 years we have seen a drop of 22.5%, but when you zoom out over the last 20, whilst they have increased it at 2.4%, we do want to point out this is below the inflation rate of 4%, and they've only been increasing those dividends for the last 3 years on a consecutive basis. Now, typically other ways that management can return excess cash to investor pockets are through share buybacks, but what Occidental Petroleum has done in fact is the opposite. They've diluted your position over the last 10 years, increasing the share count from 766 to 967. Again, just factors to consider as an investor, or in fact a prospective one. And ROIC, probably no surprises by now, we're not getting any consistency, but at least over the last 4 years it has been around the 8% that we want to see at a bare minimum for the industry overall. And finally, on the metric side, we get to the net debt to EBITDA. Remember, this highlights below the number of years it would take the company to pay off all of their debt. We want below 1.5 for the industry, sitting about that on a trailing 12-month, so not too bad. But again, this is probably something we do need to keep our eye on at least every single quarter, just to ensure they do also have a bit of room for that dividend safety. Now, if we were to compare the company against the S&P over the last year, we can see massive outperformance with the S&P up 8%. Occidental Petroleum, this includes reinvesting their dividend, down 24%. Looking at over the last 5 years, we actually get a different story, with Occidental up 418%. In comparison, whilst the S&P is up 153, it is significantly lower. And if we do then look at over the last 10 years, we get a completely different result here. S&P up 175%, Occidental Petroleum down 11%. So even over the last 10 years with this company, if you've been reinvesting the dividends, you would still be down around 11%. But as always, do remember that past performance is not an indicator of the future. They could massively outperform the S&P moving forwards, but they could also continue their underperformance. It is also worth knowing that investors are still fairly bullish on the economy overall, as we do continue to sit in extreme fear, something we have been here for nearly 1 month straight. And even though we did get a correction in the S&P this this month, we are still seeing companies in the red with some very high valuations. And actually, when we take a look at Occidental Petroleum, as we said, around the 12 mark, this is pretty much where the whole industry is sat. So whilst you could argue it is in the green, it does look fairly attractive. We also need to understand what does the sector typically trade for, and just looking at some of these companies, we can see they aren't that far off, which is why we always like to go one step further and run them through our own valuation process. Now, before we do that, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning, so new one to your inbox tomorrow, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our intrinsic price, which comes to just under $56 today, derived from these four models that you can see. Now, it is purely the average, and we can just run through the inputs of each one. We have the Graham's valuation as the first model, with the stock ticker symbol, the EPS, long-term growth rate, AAA corporate bond yield to give us our first intrinsic value showing undervaluation. But remember, we're not looking at any one model in pure isolation. Then we have the multiples model. We have P's from companies in a similar sector and size, average P multiplied by the EPS of OXY to give us our second intrinsic value. First one now showing overvaluation, so 1 for 1. And then we get to the dividend discount model. As we said, they did in fact lower the dividend not too long ago. So we've gone for 6.25%, which is lower than the last few increases. Again, you could say a bit more on the conservative side. And we get our second undervaluation signal, 2 for 1. Then we finally get to the DCF model, free cash flow for the most recent year as well. We've gone growth moving forwards at a bit of a drop, negative 2%. Again, you could argue more conservative in the episode today. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as you can see, $64. 3 undervaluations, 1 overvaluation, on average $56. And we're not done just there. We always start off with a 10% MOS. Execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. Then we keep going, so if you do believe 10% is appropriate, a buy up to $50. Right now though, at 15%, not too far off, so we would say Occidental Petroleum, 2% yield, 15% MOS at today's value, with Wall Street themselves seeing this at just under $59 over the next year, translating to 22% upside. Now, some people may want to consider this, but a larger margin of safety, 20% a buy at $45, at 25 around 42, and at 30% around 39. Right now though, as we said, around a 15% MOS, and give us your thoughts. Is this one you are looking to buy, and in fact a cheaper price than Warren Buffett? As we did note just over the last year alone, where he continues to add, is down around 25% and around 40% from its 52-week high. So give us your thoughts whether you see this as a buy, hold or sell. And don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. We are dropping a new fresh copy tomorrow morning, and come and join us in a Patreon where we do cover our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.